will it sustain? Frankly, anyone's guess. The FNO watch is telling us that there's a lot of long open interest which is happening in the in SRF, which by the way touched a fresh 52-week high yesterday. Now, before I throw it open to Tushar Mahajan to talk about the technical setup, let's look at the ET Now Greed and Fear Index, or I would say Fear and Greed Index these days, because that's where I think the market positioning is. It's tilting towards extreme fear. So the markets are not excited, they are actually nervous. Tushar Mahajan, what is your sense? If I look at the pre-election run-up of 2014 and 2004 and 2009 as well, when we were recovering from the Lehman crisis, this time around there is just no excitement, there is no built-up, there is no long positioning, so to speak, at least in the run-up to the election. Is that an indication that irrespective of the market verdict, market will not swing?
No, I think this is a function of the fact that markets are clearly undecided as to what the election verdict is going to be. We've seen a fairly sharp correction in the last about 10 days or so, and lost about 6% in that time frame. Part of it is obviously attributed to a global worry, but the fact remains that at this point in time, market participation overall is very low, positioning is very light, and which gives you some cushion on the downside, but it also means that if there is a verdict which is favorable, markets could have a fairly quick run up on the upside. To my mind, I think just the uncertainty of the markets, and we'll probably have to live with it for another 3 days before the first set of exit polls come in and impact us on Monday trading.
So let's look at both the scenarios. If markets get surprised positively, what happens to the short sellers? And if markets get disappointed, do you think the lack of liquidity could really crunch the market down? Because in a weak market, little bit of selling could have a very high impact.
Absolutely. So currently, in terms of data, what the data is pricing in, or what the market is pricing in, is about a 5.5% move post the election results. From the current levels that we are around the 11,200 mark, let's say, you're talking about probably 11,800, 850 on the upside, and on the downside you're probably talking about 10,700. So that's really the range of the market which it is predicting, which we see from data as of now. But what it means in terms of a market move, you're absolutely right that given the lack of liquidity, if there is a sell-off, if the election outcome is such that there is a sell-off happening, the down move could be fairly well exaggerated because because of lack of liquidity. Similarly, on the upside, while positioning is light, the short covers could, the guys who are short, they would have to make a quick scramble, because you are going to open up with a gap on Monday, which is post their exit poll levels, and post that is when you would have to move your positions to cover at any point in time.
But Tushar, in that gap, whichever side it may be, upside or downside, hopefully on the upside on Monday morning after exit polls, where do you see the concentration of the move happening? Would it be banks which would actually lead the market either on the upside or downside? And within banks also, would it largely be NBFCs, PSU banks and corporates would manage to stick out? How would the texture of that fall or move up, whichever way it is, be?
So clearly, given the way the index is structured and the high weightage that we have on the banks, it will be the banks. So now I think what has happened is that over a period of last few months, we've also seen a fair amount of volatility and action even in the public sector banks. So across the entire financial space, be it NBFCs, be it private sector banks, or be it public sector banks, they would combined together, they would lead the move. On the upside, my sense is that on the upside, both NBFCs and private sector banks would lead the move, and on the downside, I think public sector banks and NBFCs. So NBFCs will participate on either side of the move with the election verdict. Having said that, I think post the election, given how things move, my sense is that on the upside you could also see some kind of participation coming through from the beaten down, I won't say, not let's say beaten down, but from the relative underperformers of recent times, which is, both the auto and the consumer space, because you would expect, as if there is a favorable outcome, that amongst the first things that the government would do would be to do something to spur up the consumption demand, and you could probably see these names kind of also participate on the upside. So if you had to say that the markets from the current levels had to rally back, let's say to the 11,800 levels, my bet would be that banks, autos and consumers would lead that charge.
Okay, so banks, auto, consumers, that's what you're looking at, particularly in light of the election or that event trigger that we're watching out for. Within the banks, Tushar, if I just go a little deeper, if you could just take us through your strategy, if we kind of look at the corporates, if we look at the PSUs, NBFCs, just within that basket, if you could just break it up for us a little bit more.
So, like I said, the upside will effectively be triggered by the private sector banks and NBFCs, and I think the upside participants on the it's going to be high quality. So you'll probably see obviously HDFC Bank and Kotak, these two have to participate, but I would think that that spread gets extended over to ICICI and Axis Bank as well, to lead the charge on the upside, along with on the NBFC space possibly the likes of Bajaj Finance, HDFC, the parent, as well. So you'll probably see higher quality names lead the charge on the upside. I think there's still, and I would probably also guess on IndusInd Bank as well to move on the upside. The stock's been fairly beaten down, and it could be a good, catch-up candidate to play on the upside. I think on the downside, you could probably see some of, X of SBI, the other public sector banks, which have had a run up, which have given up their gains, and if outcome is not favorable, there could be a worry that a lot of the NPA work, which the good work done around the NPAs in the last few years, could have a chance of being eroded, and you'll see those, the non-SBI PSU banks lead the charge on the downside, along with your standard housing finance companies, etc. as well.
Short-term play, but on sectors that have been closely watching the elections, real estate, construction, housing, some of those names as well. Would they be on your radar?
So I think at this point in time, given that we are looking, given that we are looking at a sharp event, etc., these are really high beta names. I would rather play them post clarity on the elections. And again, these are more candidates to participate if if the outcome is favorable. If you think that the government is going to spur up some kind of a demand in this space. But I would not touch them right now before the elections, and try and pre-position myself on name sectors like real estate and infra for sure.
What within the broader market, Tushar, while you're making the case that yes, the Nifty is going to either gap up or gap down, and it will be pretty sensitive, but what about something beaten down like the small caps and the mid caps, which are far from a recovery? Would they as well move, and would they then move higher if it were to be a market friendly verdict, which the exit polls seem to be indicating? And from Monday then, are we going to see the mid caps turn around faster than the large caps?
Well, frankly, as bold as it may seem, I would definitely think that we are past pretty much a lot of the pain on the mid-cap stocks, so to say. I think even in the last 10 days, if you see the kind of move that we've had, for the initial part of the, for a large part of the 10 days, mid-caps had started outperforming. It was probably only on the last day, which is day before yesterday, when you saw again a sharp downtick on the mid-cap space as well. What has also been triggering a lot of this fall is the concentrated flow from foreigners into a select names, and when they start pulling out, you see the likes of a Reliance and a Levers or the IT names kind of sell off. If we are saying that an adverse election outcome is probably going to start seeing FI outflow continue to happen, that space will not impact the mid caps as much as it can. On the upside, I think if, let's say, you see a resumption of flows as well, mid caps again would get benefited by the fact that you should probably start seeing a resurgence of flows on the domestic side as well, and a return of the large part of the HNI local retail population. So to my mind, the case for mid cap stocks to stop underperforming from here on is fairly strong.
Okay. So closing comments. How do you propose one should maximize or minimize the risk on the election volatility? Don't go with any long positions, come back on Monday or come back on Friday after the verdict is out. Or events like this, they offer volatility. This is not risk. What should be a prudent strategy for someone who's not as qualified and not as sharp as you in terms of institutional investing?
So I think very clearly, if you were to play, if you have to play out on a risk, what you need to probably do, we are saying that there is going to be a gap up or a gap down moment. I think at that point, the critical levels from all kind of data setups that we see is, 11,000 is a strong support on the downside, to 12,000 is a strong upside resistance. Markets are pricing in that, in case of an adverse outcome, there could be, a move beyond the 11,000 points or something like that. I would recommend that if one were to start, really go into trade, carrying some positions on Friday night to play for the upside, you're better off, playing a spread trade on the puts, which is, you buy 11,000 puts and sell the 10,700 puts. I think that, you minimize your costs on that, and you start making money the moment, markets gap down to 11,000. I think on the upside, 10,700, 800 is a fairly strong level. So 11,700, 11,800 is a fairly strong level. So you could probably, on an upside range, buy calls for about 11,500 and sell some 11,800 calls. So you're basically playing for a spread for the markets to move down between 11,000 to 10,700 on the downside, and you're playing for the markets to kind of gap up and trade in the range of 11,500 to 11,800.
I'm glad you could join us. Markets, meanwhile, SGX is in...
So that's probably the best way through options, yeah.
Okay, appreciate your time, Tushar, and thank you for sticking your neck out and really carving out an FNO strategy or a technical strategy for our viewers.